Marcus and Sarah were both 30 years old. They both lived in Dallas. They both earned $95,000 a year. They both had $120,000 sitting in the bank. They both wanted the exact same thing: financial freedom. Marcus looked at a small rental house listed for $400,000 and smiled. Real estate made more millionaires than anything else, his friends kept telling him. The house felt real. He could drive by it, touch it, rent it out, watch someone else help pay it off. Sarah looked at the same $120,000 and did something that felt almost boring. She opened a brokerage account and started buying low-cost S&P 500 index funds. No tenants, no repairs, no open houses, just numbers on a screen. Ask almost anyone which one made the smarter decision, and they'll have an opinion in less than 5 seconds. But here's the problem. They're both convinced they're right, and they're both missing a piece of the story. Because 20 years from now, one of them could end up hundreds of thousands of dollars ahead. Or the opposite could happen. Not because one investment is magically better than the other, but because almost everyone compares these two the wrong way. People compare appreciation to appreciation. They compare home prices to stock prices. They compare headlines to headlines. Almost nobody compares cash flow, taxes, maintenance, opportunity cost, leverage, vacancy, insurance, transaction costs, and the value of time, all in one calculation. That's where the real answer lives. So to make this fair, we're giving Marcus and Sarah identical starting conditions. Same city, same income, same age, same savings, same tax situation, same investing discipline. The only thing that changes is where the money goes. And by the end of this video, you'll see why the investment almost everyone brags about isn't necessarily the one that quietly builds the most wealth. Because feelings and math are two very different things. Marcus buys the rental property. The purchase price is $400,000. He puts 20% down. That's $80,000. After closing costs, inspections, lender fees, and miscellaneous expenses, another $10,000 disappears. Before the first tenant even moves in, $90,000 of his $120,000 is already committed. His mortgage covers the remaining $320,000. With a 30-year loan at around 6.5%, his monthly principal and interest payment comes to roughly $2,000. Then reality starts adding layers. Property taxes, about 1% of the home's value, around $4,000 a year. Homeowner's insurance, another $1,500. Maintenance. Financial planners often estimate 1 to 2% of the home's value every year. Call it $5,000. There will eventually be a new roof, a broken water heater, an HVAC replacement, a leaking pipe that shows up on a Sunday afternoon. Those aren't surprises. They're expected expenses. Then Marcus hires a property manager. 8% of collected rent. Because managing tenants isn't free. Now compare that with Sarah. She invests $90,000 into a low-cost S&P 500 index fund. She keeps the remaining $30,000 as an emergency reserve. The average expense ratio, almost invisible. Some broad market index funds charge around 0.03% annually. On $90,000, that's less than $30 a year. No roof, no plumbing, no tenant calls at midnight. But here's the funny part. Sarah doesn't feel rich. Marcus does. Marcus owns a house worth $400,000. Sarah owns shares of hundreds of companies she'll probably never visit. One feels impressive. The other feels invisible. That's exactly why this comparison fools so many people. Humans don't naturally value invisible assets. If Marcus tells people he owns investment property, they usually respond with admiration. If Sarah says she owns shares in 500 companies through an index fund, most people change the subject. Yet the market doesn't care how exciting your investment sounds. It only cares about returns. Now let's see how year one actually unfolds. Marcus rents the property for about $2,700 a month. Over 12 months, that's roughly $32,400 in gross rent. Sounds fantastic. Until the expenses start arriving. Property taxes remove about $4,000. Insurance takes another $1,500. Maintenance averages around $5,000. Property management claims around $2,600. There's also advertising between tenants. Small repairs, landscaping, accounting, maybe another $1,000. Suddenly, his $32,000 of rental income doesn't look nearly as impressive. On paper, that's $32,000. Sounds great. Until you subtract everything else. After operating expenses, Marcus still has the mortgage payment waiting. Principal and interest consume nearly $24,000 during the year. Now something important happens. Part of that mortgage payment builds equity. Part disappears forever as interest. Most new investors treat the entire mortgage payment as if it's building wealth. It isn't. During the first year of a 30-year mortgage, interest eats the overwhelming majority of every payment. Only a relatively small portion actually increases Marcus's ownership. That's not a bad thing. It's just math. Meanwhile, the property itself appreciates. Let's assume a healthy but reasonable 3%. The home rises from $400,000 to roughly $412,000. Marcus proudly tells everyone, "I made $12,000 this year." Did he? Sort of. But not exactly. Because appreciation isn't spendable cash. And selling the property would trigger commissions, closing costs, and potentially taxes. Again, on paper that's $12,000. Sounds great, until you subtract everything else. Now let's check on Sarah. The stock market has a fairly average year. Let's assume the S&P 500 gains 10% before inflation. Her $90,000 grows to about $99,000. She reinvests every dividend automatically. No paperwork, no tenants, no emergency plumber, no vacancy. She spends maybe 10 minutes checking her account the entire year. Marcus spends dozens of hours interviewing tenants, reviewing repair invoices, talking with insurance companies, and signing mortgage documents. Neither investment is free. One costs money. The other costs patience. By the end of year one, Marcus looks wealthier. He owns a $412,000 property. Sarah owns a brokerage account worth just under $100,000. If you stopped the comparison right here, you'd probably declare Marcus the winner. That's exactly what most people do. And that's exactly where they make the biggest mistake. Because wealth isn't measured by the biggest asset you control. It's measured by what you actually keep after every hidden cost, every fee, every tax, every hour of work, and every dollar you could have earned somewhere else. Year one is only the beginning. The numbers become much more interesting once time starts doing the heavy lifting. And by year three, the story most people expect quietly begins to change. Marcus finishes his first year feeling confident. The property is occupied. The rent checks are arriving. The Zestimate has gone up. His friends tell him he made a great investment. Sarah finishes her first year feeling almost disappointed. There wasn't much excitement. She logged into her brokerage account a few times, watched the balance move up and down, and then went back to work. No one congratulated her. No one asked to see screenshots of her index fund. That's one of the strangest things about investing. The investments that create the most conversations aren't always the ones that create the most wealth. Now fast forward 2 more years. Year 3. Marcus's rental property has appreciated at roughly 3% per year. His $400,000 house is now worth about $437,000. On paper, that's a gain of roughly $37,000. Sounds incredible. Until you remember something almost nobody includes. Marcus still doesn't own a $437,000 house. The bank owns a large portion of it. After 3 years of mortgage payments, his loan balance has only dropped to roughly $308,000. That's because early mortgage payments are dominated by interest. His equity has grown, but not nearly as fast as many first-time investors imagine. Now let's look at the rental income. Rent has increased. Instead of $2,700 a month, Marcus now collects around $2,900. Annual gross rent climbs to nearly $35,000. Again, that number sounds impressive. Until the expenses arrive. Property taxes rise because the home is worth more. Insurance premiums increase. A storm damages part of the fence. A dishwasher fails. The HVAC needs servicing before summer. One tenant moves out after 18 months. The property sits empty for 5 weeks while repairs and cleaning are completed. Vacancy quietly removes over $3,000 of expected rental income. Notice something. Vacancy isn't dramatic. Nobody posts about vacancy on social media, but it's one of the largest costs real estate investors face over long periods. On paper, that's $35,000 in annual rent. Sounds great, until you subtract everything else. By the end of year 3, Marcus has built additional equity through appreciation and principal payments. His total equity is now roughly $129,000. Not bad at all. But remember, he started with $120,000 in cash. His actual wealth increase isn't nearly as dramatic as the property value alone suggests. Now let's visit Sarah. She never touched her investments. Every dividend stayed invested. Every monthly contribution continued automatically. Let's say she invested an additional $800 every month from her salary. Nothing flashy, just consistency. Historically, the S&P 500 has returned about 10% annually, before inflation over very long periods, although individual years can be much higher or much lower. Data published by *S&P Dow Jones Indices shows that long-term equity returns have historically rewarded patient investors despite significant short-term volatility. After 3 years, her original $90,000 has grown substantially. Combined with her monthly investments, her portfolio now sits around $155,000. No leverage, no tenants, no repairs, just time doing its job. Marcus has spent 3 years managing an asset. Sarah has spent 3 years owning businesses. That's a very important distinction. Real estate often rewards active ownership. Stocks usually reward passive ownership. Neither approach is wrong. They're simply different jobs. Here's where opportunity cost quietly enters the conversation. Marcus committed $90,000 up front. That money couldn't earn stock market returns at the same time. Every dollar invested in one asset automatically gives up the opportunity to earn returns somewhere else. Economists call this opportunity cost. Most investors never calculate it. Imagine Marcus's $90,000 could have earned an average 10% annually in an index fund. After 3 years, that alternative investment would have been worth significantly more. Does that mean buying the rental was a mistake? Not necessarily, because Marcus used something Sarah didn't. Leverage. Leverage is simply borrowing money to control a larger asset. Marcus controlled a $400,000 property using only $80,000 as a down payment. If the property rises 3%, he's earning that appreciation on the entire property value, not just on the cash he invested. That's incredibly powerful. It's also incredibly dangerous, because leverage magnifies losses just as efficiently as it magnifies gains. If home prices fall 10%, Marcus doesn't lose 10% of his investment. His equity can drop dramatically because the debt stays the same. Sarah doesn't have that problem. Her investments fluctuate daily. She'll see painful bear markets. Her account balance may fall 20 or even 30% during major downturns. But she never receives a phone call demanding another down payment because stock prices declined. Leverage creates acceleration, sometimes upward, sometimes downward. This is one of the biggest differences between these two paths. Now, let's stop talking about appreciation, because appreciation is the number everyone loves to brag about. Instead, let's talk about the number almost nobody mentions: cash flow. Marcus's rental generates income, but income and profit aren't the same thing. Suppose someone asks Marcus one simple question: how much money actually stayed in your pocket this year after every expense? Suddenly the answer becomes much smaller. Gross rent sounds impressive. Net cash flow tells the real story. After taxes, insurance, maintenance, management, vacancy, repairs, and mortgage payments, Marcus may only keep a few $1,000s in positive cash flow during certain years. Some years could even be negative, especially when a major repair arrives. One new roof, $10,000 to $15,000. One HVAC replacement, $8,000. One plumbing disaster, several thousand more. Those aren't rare events. They're predictable events spread across decades. Sarah has expenses too. Her portfolio experiences volatility. Some years it falls. Some years it rises sharply. But the operating cost of simply owning a diversified index fund remains incredibly small. One investment constantly asks for additional cash. The other usually asks for additional patience. By the end of year 3, Marcus still believes real estate is crushing stocks. Sarah still feels like she's behind because her wealth isn't visible. But appearances can be deceptive, because year 5 is where hidden costs begin separating good investments from great ones. And it's also where one overlooked number starts changing the entire comparison. Year 5. This is usually where the conversation changes. Not because the investments suddenly become different, but because time finally exposes everything people ignored at the beginning. Marcus has now owned the rental property for 5 years. The home that originally cost $400,000 has continued appreciating at roughly 3% annually. Its market value is now around $463,000. That's a gain of more than $60,000. If you only looked at Zillow, Realtor, Com, or neighborhood sales, you'd probably think Marcus is way ahead. His investment made over $60,000. That's the number people love posting online. But here's the question almost nobody asks. How much of that $60,000 does Marcus actually get to keep? Let's imagine he decides to sell today. The first expense arrives before the for sale sign even goes in the yard. Real estate commissions, around 5 to 6% in many markets. On a $463,000 home, that's roughly $23,000 to $28,000 immediately gone. Then come closing costs, title fees, transfer taxes where applicable, attorney or escrow fees depending on the state, another several $1,000s. If the property appreciated enough, taxes may also enter the conversation, depending on depreciation recapture and capital gains rules. The exact amount depends on the owner's situation and current *IRS rules. But it reminds us of something important. The sale price isn't the amount you keep. On paper, that's $63,000 in appreciation. Sounds great, until you subtract everything else. Now let's look at what happened inside the property over those 5 years. Marcus replaced the water heater, $3,000. A section of the fence blew down after severe weather, $2,000. The air conditioner finally reached the end of its life, $9,000. The property sat vacant for another month between tenants. More lost rent. None of these events were shocking. In fact, experienced investors expect them. That's why seasoned landlords don't ask, will something break? They ask, when? Now compare that with Sarah. She hasn't replaced a roof. She hasn't negotiated with contractors. She hasn't received an emergency phone call during dinner. She simply kept buying the same diversified index fund every month. Some years the market surged. Some years it dropped, but she never stopped investing. That's where compounding quietly begins showing off. Her original $90,000 has continued growing. Those monthly contributions of $800 kept arriving automatically. Now her investment account has crossed approximately $220,000. Notice something interesting. Marcus owns the larger asset. Sarah owns the larger liquid balance. Those are not the same thing. If Sarah needs $20,000 for an emergency, she can usually sell part of her portfolio within minutes during market hours. If Marcus needs $20,000 next week, he can't sell the kitchen. He can't sell half the roof. His wealth exists inside a physical asset. That's called liquidity. And liquidity has value, especially during recessions, especially during layoffs, especially when life refuses to follow your financial plan. Now here's the flip point that surprises almost everyone. For the first few years, leverage made Marcus look unstoppable. Every small increase in home prices created large percentage gains on his original cash investment, but as time passes, operating costs quietly begin eating part of those gains. Maintenance becomes more frequent, insurance becomes more expensive, property taxes increase as home values rise. Meanwhile, Sarah's expenses barely change at all. Her investment account gets larger, but the cost of owning it stays tiny. This is where simplicity becomes an advantage. Not because simple investments earn magical returns. Because simple investments create fewer opportunities for expensive mistakes. Let's pause for a moment. Imagine both Marcus and Sarah disappear for 6 months. Marcus's property doesn't disappear, but problems don't disappear either. The lawn still grows. The tenant may still call. Insurance still has to be paid. Property taxes still arrive. The mortgage company still expects payment every month. Now imagine Sarah disappears for 6 months. Her investments simply continue existing. The companies inside the index fund continue selling products, hiring employees, generating profits, paying dividends. The investment keeps working whether she checks the account or not. Again, neither investment is objectively better. They're simply different businesses. One requires more management. The other requires more emotional discipline. Because don't forget, during those 5 years, the stock market didn't move in a straight line. There were scary headlines, economic uncertainty, interest rate changes, political drama, probably at least one correction where financial news convinced millions of people the market was about to collapse forever. Sarah had to do something much harder than replacing an air conditioner. She had to do nothing. That sounds easy, until your portfolio drops 20% and every headline tells you to sell. Sometimes the hardest financial decision is refusing to make one. Meanwhile, Marcus faced different emotions. Every repair felt personal. Every vacancy felt stressful. Every interest rate headline affected refinancing opportunities. His investment demanded decisions. Sarah's investment demanded patience. Now let's introduce another cost almost nobody talks about. Time. Suppose Marcus spends only 4 hours every month dealing with his rental, phone calls, bookkeeping, tenant communication, scheduling repairs, meeting contractors. That's 48 hours a year. Over 5 years, nearly 250 hours. That's more than 6 full work weeks. If Marcus values his time at $50 an hour, that's over $12,000 of personal time devoted to managing one property. Should that count? Some people say no. Others absolutely say yes. Either way, it's a cost, because every hour spent solving one problem is an hour unavailable for earning income somewhere else, or spending time with family, or simply enjoying life. Sarah spent perhaps a few hours each year reviewing her portfolio. The difference isn't just money, it's attention, and attention is one of the most valuable resources you own. By the end of year 5, Marcus still feels like he made the smarter decision. After all, he owns real estate. Sarah still wonders if she should have bought property instead. After all, everyone keeps saying real estate is the safest investment. What's fascinating is that both of them are looking at the same numbers and reaching completely different conclusions, because neither one has asked the question that actually matters. Not, which investment went up more, but, which investment left me with more wealth after every hidden dollar was counted? And that's exactly where the comparison becomes even more interesting. Because by year 10, appreciation is no longer the biggest story. The hidden costs and the hidden advantages start doing most of the talking. By year 10, something fascinating happens. The conversations Marcus and Sarah hear from friends become completely different. 10 years ago, everyone asked Marcus one question: did you buy the property? Now they ask a different one: how many properties do you own? People assume that if one rental worked, 5 must be even better. Sarah hears something different. You've been investing in the stock market for 10 years? Weren't you scared during all those crashes? Notice how differently people judge these investments. Real estate investors are often rewarded for owning more. Stock investors are often questioned for staying invested. But markets don't hand out returns based on confidence. They hand them out based on math. Let's run the numbers. Marcus's rental property has continued appreciating at an average of 3% annually. His original $400,000 property is now worth roughly $547,000. On paper, that's about $137,000 in appreciation. Sounds incredible, until you subtract everything else. Over the past decade, property taxes have steadily increased as the home's value climbed. Insurance premiums have risen too, especially as replacement costs increased. Maintenance never stopped. In fact, older homes usually become more expensive to maintain, not less. The roof finally needed replacing. $12,000. A plumbing leak damaged part of the flooring. $4,000. Fresh paint before attracting a new tenant. $3,000. A refrigerator failed. Another $1,500. Then came a 3-month vacancy during a slower rental market. Nearly $9,000 of expected rent disappeared. Marcus isn't upset. He's prepared. Experienced landlords know these expenses are part of the business. But they're still expenses. Now let's total something most people never calculate. Over 10 years, Marcus has spent approximately around $55,000, $65,000 on maintenance and repairs. Roughly $50,000 in property taxes. Nearly $20,000 on insurance. Around $25,000 in property management fees. Approximately $15,000 lost to vacancy and tenant turnover. Combined, those hidden costs have quietly consumed well over $160,000. Think about that. Almost nobody brags about maintenance. Nobody posts pictures of property tax bills. Nobody celebrates replacing an HVAC system. But those numbers are every bit as real as appreciation. On paper, that's $137,000 in appreciation. Sounds great, until you subtract everything else. Now let's look at the mortgage. This is where Marcus finally starts seeing a meaningful change. Unlike the first few years, more of each monthly payment is now reducing principal instead of simply paying interest. His remaining loan balance has dropped substantially. His equity has grown through 3 different engines. First, home appreciation. Second, principal reduction. Third, cash flow accumulated over the years. This is why leverage can become incredibly powerful over long periods. A modest annual increase in property values compounds on the entire asset, not just the original down payment. Now let's check on Sarah. She ignored the headlines. She ignored election years. She ignored recession predictions. She ignored people saying, "This time is different." Instead, she kept buying. Every month, without exception. Over 10 years, her original $90,000 continued compounding. Her monthly investments never stopped. The dividends purchased more shares. Those shares generated additional dividends. The snowball became larger every single year. Assuming long-term market returns close to historical averages, not every year, but over the full decade, Sarah's portfolio is now approaching $400,000. She didn't find the next Apple. She didn't pick winning stocks. She simply owned hundreds of profitable companies through one diversified fund. That's the strange thing about compound growth. For years, it feels slow. Then suddenly, it doesn't. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, although historians debate whether he actually said it. Whether he did or not, the principle remains true. Compounding rewards patience far more than intelligence. Here's another difference that rarely gets discussed. Taxes. Marcus receives several valuable tax advantages. Rental property owners may deduct mortgage interest, property taxes, insurance, maintenance expenses, and depreciation, subject to *IRS rules. Those deductions can significantly improve after-tax returns, depending on income and tax situation. That's a genuine advantage. Sarah doesn't receive depreciation deductions, but she benefits from something equally powerful. She doesn't owe taxes simply because her investments increased in value. As long as she continues holding her investments without selling, unrealized gains generally aren't taxed. That allows more money to remain invested and continue compounding. Different tax systems, different advantages. Neither is automatically superior. Now imagine something unexpected happens. A recession. Housing slows. Stock prices fall. Interest rates change. Marcus's home value declines temporarily. Sarah's portfolio falls 25%. Who made the better investment? The answer depends entirely on what happens next. Because temporary declines only become permanent losses if investors panic. History shows both housing markets and stock markets have experienced painful downturns. History also shows both have recovered over long periods, although no future return is ever guaranteed. That's why investing isn't about predicting next year. It's about surviving the next 20. Now let's talk about something money can't easily measure. Stress. Marcus worries about one property, one roof, one neighborhood, one tenant. Sarah owns tiny pieces of hundreds of companies across multiple industries: technology, healthcare, financials, consumer goods, industrial manufacturing, energy. If one company struggles, hundreds of others continue operating. Diversification isn't exciting. It's simply risk spread across many businesses instead of one address. Again, neither investment is perfect. Real estate offers leverage, control, and potential tax benefits. Stocks offer diversification, liquidity, and remarkable simplicity. So which one wins? At year 10, you still can't answer that question honestly, because we're still missing the part almost every YouTube video skips: the hidden numbers nobody talks about. Not appreciation, not returns, not net worth. The costs hiding underneath both investments that quietly determine who actually keeps more money. And once you see those, the comparison changes completely.